it will be quite difficult for a foreigner, especially central banks, to put their money in dollars, knowing that the president is going to be against their interest if there is anything wrong.
So 35 years ago, Regan and Thatcher, they pushed for deregulations on finalisations, which in turn pushed interest rates lower and lower. Now with May and Trump, could we see that being reversed and the trend changing?
I think there is a parallel which is really interesting between what happened 35 years ago with Thatcher and Reagan, and maybe what could start with Theresa May in the UK again, and with Trump. And it's sort of which trend is going to be reversed? Is there something in common with what started 35 years ago, as you mentioned, very much into the finance, very much into deregulation, and sort of the people's vote that brought the Brexit and Trump? It seems that the forces behind, in terms of what the ideology or what the voter are expecting, is less deregulation in terms of globalization, so more trade, tariffs, less free trade, more protectionism. I think this is really the common factor between the two, and this would really be a global trend going forward. And the second one is about inequality in the system. There are winners of the systems and there are losers, and it seems that the losers have voted, and it's sort of rebalancing of those two, the whole internal equilibrium of free markets. So it's interesting, as 35 years ago it happened in Anglo-Saxon countries. It happened again this time in Anglo-Saxon countries, where I think the extreme of free market went as far as it happened in the UK and in the US. So it's interesting. We'll see if it happens also in core Europe. But I think we didn't go into that extreme in terms of inequality, in terms of resentment against the globalization, but it's yet to be seen. So the big question, I think, in the finance is how this affects asset prices.
So has there been a decline in long-term interest rates?
So in fact, the main trend that happens, if we date the conservative, the revolution with Reagan and Thatcher, is this long-term decline in interest rates. We've been fighting inflation, deregulation, globalization, all those trends, and even demographics have helped interest rate go down for 35 years with just cyclical adjustments. And they are at all-time low. They even hit all-time lows the next day of the Brexit, and they've been going up for the last few months. And yesterday with the election, even interest rate in the US has gone up. So there is a big uncertainty about those trends that brought interest rate down. Are they going to be reversed? And I think this is the billion-dollar question: is what drove those factors down? Are driven by politics, but also driven by demographics. Aging favors savings and favors declining interest rates. So I think it's worth looking at what would change, and how the Trump or the May administration could bring this up. I think the big change is regard to what they do on the fiscal side, and this is what we have on the program of Trump. Is there might be big fiscal spending coming up. Fiscal spending on the Republican side is usually not coming financed by tax, but financed by debt. So we have, Reagan was huge in fiscal deficit, and same for Bush. And I think Trump could bring back big spending and tax cuts. And this in turn is very bad for interest rates. Clearly, the fact that you cut tax, you promote spending, you increase the debt, this has an inflationary impact, and this has an impact on the need of financing. So those two impacts could increase the long-term interest rates and really turn upside down the trend we have. Then is this trend going forward, let's say, for 10 years? I don't think so. I still think demographics is the superior force than everything else. But at least for a few years, we really could have a tension on the interest rates. I think now 10-year yield in the US has gone above 2%. Now market will look at 2.5% and 3%. Is this what will happen in in the bond market, and there's big tension about a crack in the bond market and crash in the bond market. So short term, it relates to what the Fed is going to do, how the Fed is going to manage the Trump administration. They are not friends. The Fed is mostly Democrat, and Trump has clearly been criticizing the Fed harshly. So I don't think there will be a very constructive and friendly relationship going forward. So in all, there could clearly be a scenario of tension on interest rate, meaning the interest rate would go up for at least 2 years.
So how has this all impacted asset allocation?
Yeah, so going back to your first question is, the election and how this affects. At the end, it relates to not only interest rates, but really how you allocate your portfolio on a long-term basis. On a daily basis, I think election doesn't really matter. It's most about volatility than anything else. But on a 10 years perspective, there's big differences between a Clinton administration, a Reagan administration, or a Nixon and Carter administration. I think we have to go back to sort of the four cornerstone of asset allocation: cash, bonds, equities, and gold. And we've been focusing for last few years, for last few decades, on a sort of classical mode of bonds to equities. And I think we have to enlarge again cash, bonds, equities, and gold. I think we'll have again, if interest rates goes up, an arbitrage between cash and bonds. It will not be always good to have bonds, but cash will go back into being an attractive asset.
Well, thank you for joining us in our studios today. It's been a pleasure.
Thanks a lot.
And thank you at home for watching. Don't forget you can catch previous interviews by clicking on our channel. Goodbye for now.